Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, it's time for our weekly Bitcoin update. We've got quite a few things to look at, a couple of counts to look at and some interesting price action over the last couple of days to look at as well. But first, a quick word about the many benefits of becoming a member of the Green Star Trading Patreon. If you already appreciate the work I'm doing on YouTube and wish to show your support for the channel, then why not join Tier 1 for just £5 a month? You still bag yourself an exclusive video each week that won't be available on YouTube. Or why not consider joining Tier 2 for just £10 a month? You still get the same exclusive video each week, but you also get access to the public Discord. There are multiple channels where you can discuss things to your heart's content on multiple subjects with all other Discord members, including myself. You also get access to the entire back catalogue of my educational videos, including the Elliott Wave series, plus other technical analysis videos, including trading and trading risk management. I also host a live session each week via private link to the YouTube. Then finally, Tier 3. For £15 a month, you get all of the previously mentioned benefits from Tier 1 and Tier 2, but you also get access to my monthly dividend calendar where I list my stock picks for the month and all of the relevant ex-dividend and payment dates. You also get access to my stock rating system, which is an at-a-glance rating out of 30 based on company health, value and overall dividend quality. If you yourself wish to look up a specific ex-dividend date or payment date, tag me on the Discord and I can look it up and get back to you. Also, if there's a stock you're interested in and you want me to use my rating system on the stock that you have chosen, tag me in the Discord and I will get back to you with a score. Thanks for listening, guys, and now back to the video. Okay, welcome back, guys. Right, before we begin, I just want to thank all of my patrons who attended the YouTube live stream on Thursday. Obviously, we do that via invitation only. I send out the link on the Patreon on the Discord. It was a brilliant session. Our first time we've done it on YouTube. I think it went really well. I ended up chatting for 5.5 hours with you guys. And this is why there's only been 2 YouTube videos this week. I basically burnt out my voice again and had to give it a rest the following day. But I just wanted to say I felt it was very successful, went very well, and that's the format we're going to be sticking with going forward. So I'm looking forward to next week's live stream as well. I will let you know when that is. And yeah, just wanted to thank you for your participation. Had some very interesting questions. It was nice seeing people involve themselves in the chat. And if you have any ideas that you want to see included in next week's live stream, use the Discord live stream analysis channel to suggest some ideas, and I will go through them and see what kind of support there is for them. Also, if you're not a member of the Green Star Trading Patreon yet, and you're interested in something like the weekly live stream, then feel free to consider becoming one, and it's one of the many benefits you can get from joining. But enough shilling my my own interests for a moment, and let's get back to Bitcoin. So, for what feels like a very long time now, it really isn't in the grand scheme of things, but it does feel like quite a long time now. We've been sticking with this count, which is the idea that we've got a free wave move, which is going to complete either before these lows as a running flat, or will expand beyond them as an expanding flat. Okay, I think I've become more partial to the idea of completing prior to these lows now. I'm not saying that's definitely going to be the case, but given the structure we've put in so far and the count I have in place, it feels like if we put in 4 waves and are now in the fifth would have to be very extended, and I don't see evidence of an extension yet in the 5th wave. And it should have showed up by now if we were going 1-2, 1-2, and it doesn't appear to have occurred. So in that sense, I'm not expecting significantly lower lows. I think we'll either find support around our point of control, which is the yellow dashed line on our fixed volume here, and somewhere around all this prior noise, is my suspicion, which would also basically line up with the bottom of the regression channel we've got going on here. Now, I do have a count where we've bottomed and we're going higher, and we'll definitely go into that later. It's more detailed than the count you can see in the short term here, so I haven't bothered over-labeling the bearish count here, as we're going to be looking at the more detailed version with the bullish count. But I'm a man who likes to be proven wrong definitively before I jump onto a new bandwagon. So, in that sense, we are looking at an invalidation level for what we're assuming is a wave 1, wave 2, wave 3 now done, and a wave 4 coming up. So if a wave 4 were to transgress beyond 45693 spot 17, I have it here as, that's just a tag though. The precise measurement is here on the right hand side, which is 45655 spot 31. If we were to come through this level here, that invalidates the idea of this being a 5-wave impulse lower. If we were to see some kind of 1, 2, 3, 4, 5-wave move out of the regression channel and breaking this invalidation level, then the likelihood of having bottomed greatly increases. It also opens up an alternative count, which we are also going to look at today. We haven't looked at that one, which is a triangle, for the best part of over a month now since I first brought it up. So we'll come back and have a look at that. I didn't mention it last week because I didn't think it had, until we pivoted, and we may have pivoted. I'm not saying we have, we may have done. There was no point in mentioning it, so we'll come back and look at that in a little while. So essentially, 1, 2, 3, 4's coming in, 4's coming in, or is either already in, and we're about to have another 5-wave move down to the bottom of the regression channel, into all this previous support, into this point of control, probably towards a major fib level. Let's just have a quick check here. The 89 fib is down here. If we switch into the log, the 78.6 is on the line with the point of control down here. So there is confluence down here with the edge of the channel and the point of control. If we take our fib extension of our A and project it from our B, we've also got the 123.6 down here with the 89, and if we switch into the log, we can see that it's a 1-to-1 right around our point of control. So we've got the length of A projected from B comes back to 78.6% of this move up, and also a 1-to-1 extension of the A from the B in log around our point of control at the edge of our regression channel. So there's a whole bunch of confluence down here waiting to provide support. Okay. It doesn't necessarily have to be where we're going to go, of course. We may have bottom, we may finish before that, but it just feels like a likely place. Now, I've been going back and forth on the Discord over months now discussing this overall structure, and although I'm not entirely happy with how I've got this impulse down here, it is legal. I've got a 1 and a 2, a 3 which is not the shortest, a 4 which doesn't overlap the 1, and now in a 5. It's not a particularly pretty impulse, but out of all the alternatives for how we get down here, it's still overall my preference. Now, I've seen multiple Elliottians over the months look at this in different ways, and that's cool, that's fine. I see this as, an expanding flat, or sorry, a running flat most likely. Could be an expanding flat. I've seen a zigzag, a double zigzag proposed as well, whereas this has been expressed as a zigzag, and then this is a zigzag, and then this will be a zigzag as a WXY. Now the point is, we're going to end up in roughly the same place anyway, so it really is nitpicking at this point. It's not really important. Overall, we're going to have roughly the same projections. I would have to call it a combination if I was going to label it WXY, because I've got a flat in my first move, not a zigzag. I've got what I think is 3, 3, and then a clear 5 here. So it would be WXY, and I would be a combination here, starting with a flat into a zigzag. But either way, projecting this move from this move is going to give us roughly the same terminus. An expanding flat, if we were to come down and break these lows, could actually give us a deeper terminus to the 1618 of the length of A. So we could actually end up even further away than a combination wave or a double zigzag has been proposed. My point is, it doesn't matter really. We're all agreed that there's a swing high here rather than an impulse. It is an option that it's an impulse and that this is a deep ABC. That's an alternative, but from a primary perspective, a primary count perspective, I favour this being a large free wave pattern. Right, so we've done that, we've spoken about that, we've got our 1, 2, 3, 4 here in it's legal, we're coming down in the 5th, we've got our invalidation point, so let's turn off the bearish count now. I've spoken about our confluence levels and our point of control, so we've got our rough targets down there. Tell you what we'll do then, before we go, we'll create a, because I've already got a target box, but it's a big one, right? It's this thing. It's from the 100 to the 1618. So let's try and narrow that down before we go, since we pointed out the areas of confluence that we had down here. Okay. Now I felt that the log scale was giving us the greatest level of confluence. Now you should take measurements in arithmetic, of course you should, and I believe that you might as well take them in log as well and see what is the best fit. I wouldn't say that's always the case, but when you're dealing with assets that swing, you know, 30, 40, 50, 60% one way, and 50, 60, 70% the other way, and then 50, 60, 70, 80% the other way, or whatever it is, you're dealing with such huge price skews over a relatively short period of time, and I think you can afford to look at things in log and account for that movement in that way. So let's just put one there. I think I've just done that twice, haven't I? Yes, I did. And that's the 100, and we also had the 78.6 back here, right above the point of control. I'll do that in blue, and we've got our point of control itself, okay, which obviously doesn't change, you know, it stays the same regardless of whether you're in log or arithmetic, because it's a measure of market acceptance and volume. How many buyers and sellers there were doesn't change, so I'll lock that in place as well. And with our point of control, these are both log targets, so I will say that. I know what that's going to mean. That means C equals A and 78.6% retracement in log. And then we've got a point of control. So that gives us a target area down here. So if we just split the diff somewhere around 34 grand, I would expect to see it very strong support come in. And the potential bottom. Could go deeper, but a potential bottom around here. Now that helps shrink down that large target box we've got, which is still legit. So we're going to throw those into our bear case folder here, and then we're going to turn that off and consider if we bottomed off the low here. Now when I was on the live stream, we had a nice chat about the possibility of this being a diagonal, an expanding leading diagonal 53535 instead of 33333, and I was not at all fond of the idea, and I'm still not, because it's just stretching the expectations of what we expect to see in Elliott Wave so far, and I feel like I'm bending so many rules at that point that I'm just not happy, so I'd rather try and dig out an impulse. Now the problem I had was trying to get a subwave in here. If we're saying this is a 1-2 pivot here, and then this is a subwave, right, 5 waves into a 3, into a 4, into a 5, then getting a 3 which was long enough turned out to be impossible. I measured that multiple times and couldn't do it, so I gave up on it at the time. The expanding leading diagonal idea, which would now look something like this from the 2, not the 1, not the start of the 1. The idea, the suggestion was 1, 2, and then A, B, C up to here for 3, then a 3 move here into 4, and then 3 moves here, falling short of the trend line 5. 3 longer than the 1, 4 bigger than the 2, 5 bigger than the 3. Now what I don't like about this is the whole thing, we rely on a swing high here, so this becomes the flat. Even if you have the 3 here, this is higher. I want a diagonal to be a series of zigzags, and if I'm going to entertain a 5-3-5-3-5 zigzag, then I want the 3s to at least be zigzags. Otherwise, a lot of the initial concept and the idea and guidelines and rules laid down by Elliott Wave are just being completely thrown out of the window. So at that point, I don't know what the verdict is on whether or not you can include triangles, flats, within the corrective element of a 53535 leading diagonal of an expanding variety? I literally don't know, because there's nothing written in Elliott Wave about it. I think you're just taking a bit of a liberty at that point. You might be right to do so, you might be wrong. I'm not comfortable taking that liberty. I'm always happier when I see free, 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 if it's expanding, and conversely if it's contracting. Alright, I could live with the idea of 53535, but once we start throwing in any corrective pattern we like, I'm starting to get a little uncomfortable. Now, if that's what you've got and you're happy with that, that's cool, but I have found a way up here as an impulse instead, which I could not see at the time on the live stream. So let's bring that up. Bottom in, I've called it. Okay, so this is what I've gone with. We've got our, and I don't like it, we've got our 1, 2, and this is that huge candle wick. You know, we always come out of a wick into a 1. This is a 15-minute time frame. If we look at this on longer time frames, 4-hour, 8-hour, daily, then it's just a single candle we're doing all of this in. The 1 and the 2's within the next candle, which is very extreme, fast move, but you know, it's crypto, I'll give it the benefit of a doubt. Now here I can say fair enough, we come into a 1, then we get an expanding pattern into a 2. This creates a lower top for the 1 here, which is not transgressed by my 4 here. Okay, so I can get an impulse subwave into here now. At this point, if I finish the 5 early and I go for a running triangle, so I'm not putting the 5 here, I put in the 5 here, then the 3 is marginally longer than the 5, and therefore it's not the shortest, there's no overlap, and that is a legitimate impulse wave, and the 3 has to be a pure impulse. It can't be a diagonal, it can't have any overlapping, the 3 must not be the shortest, so on and so forth. It has to be a pure impulse, and I've picked out a subwave there where I've managed it. I'm not particularly convinced at all by it, but it's there. So A, B, C, D, E, and then a charge up in a very short impulse here. It is there if we come down to a smaller time frame, but you have to come down to a smaller time frame to see it. Let's just save that there. Okay, at that point we get an ABC zigzag. 1, 2, 3, 4, 5. ABC 1, 2, 3, 4, 5, or 1, 2, 3, 4, 5 into a 2, and now we're impulsing back out of here, and this is going to be a 1, and then we're going to come back into a 2, 3, 4, 5 at minute degree, and we're going to continue higher. Okay, that's the bullish interpretation as I see it. I'm weighting this lower than I am my bearish count still for the moment. As I said, I am a man who prefers to be proven wrong than proven right, and in that case I would like to see the invalidation point back here at our wave 1, this get breached. So back in the bear case, it's here, 4, 5, 6, 9, 3, spot 1, 7. So if we continue to impulse 1, 2, 1, 2, 3, 4, 5, 3, 4, 5, and we break this invalidation point, volume starts to pick up during this proposed third wave, right? Momentum turns positive and continues to climb. Then at that point, I'm going to start thinking we've bottomed, or at least it's a much stronger option to have bottomed. There is still an alternative, but it's more likely at that point than this bearish case is, because we can't keep coming down in the way that we've proposed because we've invalidated it. All right, but we haven't seen that yet. Now, you might say, oh well, when you get people, I often feel, are in a bit of a hurry, and that's fine, I understand, you want to get in, but remember that this is fractal. So if this is a 1, 2, if you've taken this trade here, you could take this trade now if you wanted. This is an STS waiting to happen, standard trade setup, as we talk about on the Patreon. This would be a stop, your entry is going to be somewhere in this box here, and then you're off up into a 3 potentially, or worst case scenario C. So this is tradable right now from a long position, okay? But let's say you don't get it and you wait. 1, 2, 3, 4, 5, right? A, B, C. Here's your next opportunity, because this is now a 1 and this is now a 2. Alright, 2 could be shallower, could be here, but you're going to get 3 wave structure, ABC flat or ABC zigzag or whatever. You will not get a triangle because it's a wave 2. Alright, so it's never too late. You've just got to wait for the setup to arrive. And of course, as I always say, the earlier you take something, the more profit you can make, the smaller risk you can manage, but the more likely you're wrong. The longer you wait, the more likely you're right, the bigger risk you have to take in terms of the size of stop. Normally you can try and get it down, but wave 3s, if you miss the boat on a larger degree, are incredibly unforgiving in terms of giving you an opportunity to get in. We just want to be there before that happens. But like I said, 5 waves in a 1 before that becomes a problem. So that's how I get off a low with an impulse. So it is possible. Right, so now that we've discussed the bullish case, which is with bottomed, and we've discussed the bearish case, let's discuss finally before we go, and we'll look at some basic technical analysis before we go as well. I'll just add these to the bottom in. We've got one other thing we are going to consider, which is an idea we were discussing on the Patreon. We've discussed a few times now over the last few months, and we've come back to it time and time again, but I've said until we get this next leg in, we can't be sure. Excuse me. And that's the idea that we're actually in a triangle. Okay, a running triangle, because the B wave is expansive. So we can take that idea that this is a zigzag of some sort, or we can take my flat here, or you could even take WXY complex in an A wave of a triangle. Not a fan of that at all, but either way, 3 wave move into an A, 3 wave move into a B. This would now become an A and a B and a C, probably come down deeper actually. Yeah, it might not be done at all. Could fit the bearish case in terms of actually being an ABC for a triangle, right? With a 5th wave down to come down, so A, B, C down to here. Then a D, which will be, nobody knows what this will be. This is why we haven't been discussing it, because this could be a barrier triangle, right? Where you're going to come all the way from down to here, and then you're going to go 3 waves right back to the top, and then you're going to go 3 waves down into an E, and then you're going to finally go sometime out in the summer. You know, it could be contracting, and you could get up here way sooner, right? Maybe even next month, February. Then you could be back down into late April or something like that. And then you could be on your way out through May and June. But the reason I haven't really gone back and forth on this one is because until you get 4 waves of your triangle done, especially if you've got an expanding running triangle, you can't get your top trend line in place. And until you get your top trend line in place, whether it's a barrier or a contracting triangle with a reversal, you can't have any real guesstimation at all of how long this thing's going to take, or any confirmation of its structure. You know, we're expecting one complex wave within a triangle and the rest to be a series of zigzags. You know, that complex can take the form of a double zigzag, a combination. It can even take the form of another triangle. You know, but until we see something that helps us confirm it, it's way simpler to just say 3 waves. An Elliott wave is a, you know, essentially an activity about probabilities. We're trying to pick the most likely probability, and therefore we tend to lean towards the simplest interpretation wherever possible. And there are simpler interpretations to the triangle. I've just been tapped and told that I need to talk about the bullish count that isn't just a low here. Alright, the bullish count, which is the idea that this is an impulse. So here we go. Looks complicated, but it really isn't. This idea, and I've seen several people count this differently. I've seen 1, 2, 3, 4, 5. You know, I personally prefer this to be 1 wave. This is 2 as a zigzag, 3, 4 as a complex, and then 5. You know, not the best looking, but you could argue maybe this is better looking, but I struggled to get out an impulse in that one. But at least it looks like a better impulse. But regardless, the point is, this now becomes A. This now becomes B, and this now becomes 1, 2, 3, 4, 5, C, 2 before the lows, and then off we go. Now, as you can tell, whether this is 3 or 1, 2, it's really not going to matter. But the only difference is we'll come in for definite before these lows. 100% guaranteed coming before these lows if this is correct. We have to, otherwise it can't be possible. The bearish count allows us to break those lows. So marginally more bullish in the short term. However, less bullish in the long term, because this assumes the fall is already done and that this is 1 and 2. Our fall is going to be over here and our 1, 2 is going to be this. So we're going to be going into a 3 in this count, whereas the 3 for the other count will start over here, so we'd be way higher up, right? Haven't even done our 1, 2 yet by the bearish count, so perversely the bearish count is more bullish and the bullish count is more bearish. Okay, right then. Okay, so that is, I think that's everything I want to talk about today. Let's just have a look at some basic analysis before we go. Bring up our momentum indicators here. See if we can find any divergences on any time frames we're considering. We'll bring up our moving ribbon, Elliott wave. What am I talking about? Exponential moving averages as well. Our EMAs. Let's come down to the weekly time frame first. Okay. Right, so we had, as we were recording, as it was occurring, during our, God, when was it? Months ago. Well, obviously it was back in February 21, when we were talking about the possibility of this having been a fifth wave ending diagonal, right? And therefore, whether we were about to go into whether we had an expansive wave as I've got it, or whether it was an expanding diagonal, the divergence we saw prior on the weekly made total sense, because an expansive wave will be on weakening momentum, just as an ending diagonal tends to be. So they're really kind of inseparable in terms of how they appear from an RSI point of view. But that then played out into this big correction here, swing to a higher high in price and a lower high in RSI, supporting the idea that this is an intermediary swing, a B wave swing as part of a larger pattern, as it was achieved on lower momentum. Okay. Same here with the MACD. Do we have any kind of divergence on the daily time frame? There was none there on the weekly. Marginal, really marginal. It's there, but it's tiny. So zoom in here. Right, so let's look at these two wicks. We've got a low and a lower low, and we have got a low and a higher low. There you go, bullish divergence. It's only over a 3-day period, very teeny tiny divergence, but it exists and it's there. I think it is more present on the well, actually we've got a greater divergence on the MACD building up for longer from this low back here. Actually, from this low? Yes, from that, somewhere in between the two is because of this volatility spike here, this liquidation spike. Let's just shift it into line for a moment so we don't have to deal with that. See if we can get a better line up with the RSI. It's actually that low with the MACD, I should say. So here to here is the divergence, and here to here is the bullish divergence in the MACD. So more present in the MACD, easier to see without that big volatility spike. But even with the wick taken into account, then it's still, I mean, people have asked me, why do you take the wicks into account with your RSI and your divergence? Now the thing is, if the wick is making it extreme, right, all the way here, and you still get divergence, even with an extreme wick, then you can bloody well guarantee that you definitely got divergence on the close, because the fucking close was all the way back here, right? If you can account for the extreme move and still get your divergence, that's very reassuring. You know, now the second reason I do both. I'll look from the body and the close for divergence as well, but the other reason I include the wick is because I want to know how the divergence in the momentum indicators and my assumption of a 3 or a 4 or a 5 or an ending diagonal or an expanding B or a flat or whatever. I want to know how it relates to my Elliott wave count. So I want to know how that divergence relates to what I would expect to see given the Elliott wave count. And we have to take wicks into account in Elliott waves, so that's one of the reasons why I tend to do it. I understand anyone who says, oh, you should be taking it from the close. You are absolutely right. From a classical analysis point of view, you are absolutely right. It should be taken from the close, but there are benefits to doing it from the wick. First of all, you accommodate for all the volatility, in which case if you can still achieve a divergence between a much shallower angle here, then you definitely got it. And also for the Elliott wave reason. So we are below all our major moving averages. We're closing in on the depth cross here between the 60 and the 250. Hasn't occurred yet. The divergence isn't particularly strong, so this could be 1, 2, 3, 4, 5 into a depth cross, which if it comes into this territory of confluence, I'm always talking about them, but that could well be a signal of a low coming into place, because that could be capitulation moment. People see that and they give up, and that's the exact moment of market bottoms, which is when the last people who are going to give up, because everyone who's going to sell is sold. Alright then, there is a difference though between certain depth crosses, even negative depth crosses, which is two downtrending moving averages, right, can still signify a low. Doesn't necessarily signify a bottom at all, but it will temporarily normally signify a low. Take for example this one here, not long after, here's a low. Now it wasn't the bottom, right, that occurred prior to the depth cross in this case, alright, but we did get a low and then we had this move up. Right, now there are those circumstances where you will only come back up to test the average and then you'll collapse post depth cross. So whether it's a bottom or a low, it tends to occur either way, but it doesn't necessarily follow through that you're going to have bullish behavior afterwards. You will have temporary bullish behavior at least. That is so often the case, it's freaky, but it doesn't mean it necessarily translates into a bullish situation. So take for example the depth cross back here. This is a good example of what I mean. Now I know I'm going on a bit, but here's another depth cross. Both are trending down at this point. Here's our depth cross, here's our low a little while later. Okay, bounce, but it wasn't bullish in the long term. Boom, came to another low. Alright, so yes, it does often signify a low, but it doesn't necessarily signify a bottom. So if I've always tried to clarify that when talking about it. I don't want to say it's a way of guaranteeing a bottom. It's not at all, but it is very much often a signifier of at least a local low occurring. Here's another one, both trending down again, classic depth cross, and it happens to signify this low, which is the market's already bottomed by the time depth cross occurs. Right, we now rip out of here to 69 grand. So I know I sound like a broken record, but I'm just going to keep saying it because I want to try and, in my opinion, get people away from these more classical mistakes. You know, because it's not about whether you're right in the long term here for a trader, right? That'd be great if you're managing risk and you're not leveraged, right? But if you were to come in here now, even though you come to a lower low later and you would have made money on buying this depth cross, okay, selling this depth cross, here's the problem. If you come in here on leverage because you've got this depth cross, then you get even a temporary low, this reversal will annihilate you. I mean, yes, you can have a stop in place, but there's a lot of people take stupid risks and then you can get just smashed. Okay, so I'm just saying that even though it may signify future bearish behavior, it doesn't always at all, but even if it does, it's still highly likely you're going to have a temporary low at least, and that could reverse violently, and if you started selling on it, you could be very upset. Alright then, so there you go. We haven't achieved that yet, we haven't got that depth cross yet, but a little push for lower could easily bring us down. I mean, what am I saying from where we are now? That could be another 21% fall from here, that could. From where we are now, we could give up another 20 odd percent. That could easily be enough to bring on a real wave of bearish sentiment. Right? And is sentiment bearish enough for the market to have bottomed? That's a fundamental debate, isn't it? Alright then guys, I think I'm waffling now, so thank you very much for joining me. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. As always, massive thank you to my Patreon supporters, subscribers, sorry. Your support is greatly appreciated. If you're interested in becoming a Patreon, follow the link in the description below, have a read of the tiers, see if there's anything you're interested in, feel free to sign up. Also, if you're not following me on Twitter yet, please do so, as I always I always announce on Twitter when I load up a new YouTube video in case people don't get their notifications. Alright guys, take care of yourselves and I'll be back with you next week. All the best. Bye bye.